Hey guys, Gray Mountain here with That Properties. I'm in the home office this morning and just going over some numbers for a first-time home buyer client that's actually looking to strike while the rates are still manageable for them, really. So we've been working with Brian Sewell over at Cherry Creek Mortgage Company on an FHA option. So what I found out recently is that a lot of people still don't know what the heck an FHA loan is. So here's the skinny on FHA loans, and I promise we'll make this quick. So, Brian, Federal Housing Administration loans, FHA loans for short, are popular with first-time home buyers, right?
Right. Not only first-time home buyer, I mean, it allows them to buy a home with less than 20% down or 10% down, and even if they have some blemishes on their credit. So it's a great program for first-time home buyers, and maybe for someone that's just coming back from a devastation or something like that, a setback.
Gotcha. Okay, so let's talk about qualifying real quick. Credit score, right? We always hear about credit score. We always, it's been really tough after the, let's say, the meltdown, the subprime market, that, credit scores. It's been hard for people to obtain those conventional, those loans that, are normally out there, those fixed 30s and stuff like that. So what's the credit got to look like for somebody?
Minimum credit score is 620. I mean, there are a couple of programs, loans for FHA that allows you to go under 620, and we can talk about that another day if you like. But 620 is the normal for FHA.
Gotcha. Okay, so FHA, looking at 620 or so. What's our down payment? What's so you kind of said somebody can't put 20% down or something like that. What's the minimum down payment?
3.5%. Not a lot of money, man. So you buy $100,000 property is 3.5% is $3,500. Quick math. $200,000 property is $7,000. So it's not a ton of money, and even the down payment can be gifted from a family member as well. So it's something you can go into and not have to put a huge down payment and still get in the home and be able to have the tax benefits and things of that nature buying a home.
Gotcha. Okay, so we're talking 3.5% down. Some of that can be gifted and all that kind of stuff. But here's the question. Lower down payment typically means higher rate, right? So are people going into an FHA, what's the deal with the rate as compared to where they would be if they could put that more money down?
No, so that's not true. I just actually quoted someone $250,000 purchase price. I compared FHA to conventional, and so FHA right now on a $250,000 house with good credit is about 3.75. And compared to conventional, which is 4.125, so it's about a 0.25% or 0.5%, a little bit, 0.375% lower than what the conventional rates are. The difference is the rates are lower, but there's MI, mortgage insurance on there as well.
That's incredible, man. That's okay. So mortgage insurance, right? So the government just dropped the rate for the mortgage insurance a couple days ago?
Yes. So they dropped the rate. It used to be that the monthly mortgage insurance was 0.85, and it went down to 0.6. Let's make that very simple numbers, though. It's saving the average homeowner about $500 a year for mortgage insurance. So that's a lot of good things in there. That means the market's getting better. That means economy's getting a little better, and the government's allowing us to lend and not hit the homeowner as hard. So an average homeowner would save about $500 a year compared to when they purchased a home last year. Now you save about $500 a year in mortgage insurance, so it's not that bad.
Golly, man, that's pretty cool, dude. Okay, so one final thing, debt to income. All right, like that seems to be eating people up a lot, and has been in the past. That whole debt to income ratio, right? So that number, what's it at for FHA?
Well, the normal is like 41 or 43 on the back end. We can go up to 50 with compensating factors. So what that means is you got money in the bank or no housing shock. And what housing shock means is if you're paying $1,500 a month in rent, which you're throwing a lot of money away for your landlord at that, you could buy a house at $1,500 a month, and as long as we can show that you're able to afford it, common sense things. We've also taken people up to 56% on the back end, with compensating factors. So I'll give you another example. Let's say you have a spouse that's not going on the loan because of maybe they had a bankruptcy from a previous marriage or something like that. We can still use. We can look and say, okay, there's more income in here that satisfies that. Also with reserves. showing the housing shock that you're able to afford it. So we typically require 3 months reserves minimum to go that high. And basically what that means is if your mortgage payment is going to be $1,500, we need $4,500 in the bank to show that, you're covered just in case something happens. So there's other things, other factors that you can put in place to where we would have to go that far up on a debt ratio. We want you to be able to afford the home. We don't want you to be out of your home for years to come. But as long as it makes sense and you have the compensating factors with our reserves or no housing shock, then we're able to push the envelope a little bit on that.
Brian, awesome, man. You've given me a ton of information that I actually honestly didn't have. So I'm hoping to give you guys some information too that you may have been looking for as well. So that's all I got for you today. Guys, if you're looking for more information on this specific type of loan or any other loan, honestly, reach out to my guy, Brian Sewell over at Cherry Creek Mortgage. I'll put his information down at the bottom. One of the most brilliant minds I know in the lending game. All right, so I hope to see you guys back here soon, and we'll see you later.
Hey, appreciate that, Graham. Thanks a lot.
Bye.